Shares of Warner Bros. Discovery have rocketed higher in the past hour after the media giant stunned investors by announcing an imminent breakup into two standalone public companies. Under the plan, one new entity, dubbed Streaming and Studios, will combine HBO Max, Warner's film and television production arms, and the DC Studios banner, while a second business called Global Networks will house cable mainstays like CNN, TNT, Discovery Plus, and dozens of international channels. Wall Street cheered the move as a masterstroke in value creation. By separating its high-growth streaming business from the slower-growth cable networks, Warner Bros. Discovery aims to attract a premium valuation for its digital assets while allowing the newly independent Global Networks division to focus on using its robust cash flows to tackle a staggering $34 billion debt load. In practice, this carve-up means investors can buy pure-play exposure to HBO Max's subscriber growth and blockbuster movie franchises, or stake a claim in the steady revenue stream of legacy cable channels without cross-subsidizing each other's operations. Intraday trading has been frenetic. The stock popped through key resistance levels as Morgan Stanley and other top analysts publicly raised their sum-of-the-parts valuations, arguing that the market would assign significantly higher multiples to a standalone streaming company than to a sprawling conglomerate. Meanwhile, the promise of cleaner balance sheets and sharper strategic focus has driven a rush of buy orders for the Global Network spin-out, which investors believe will pay down debt aggressively and potentially return capital through dividends or share buybacks. This isn't the first time the entertainment industry has embraced splits to unlock value, but it is one of the most ambitious. The two new Warner Bros. Discovery companies will each require fresh management teams, separate boards, and distinct branding, all of which carry execution risks and substantial one-time separation costs. Yet the upside is hard to ignore. Pure-play streaming peers like Netflix and Disney Plus routinely trade at sky-high earnings multiples, and a standalone Warner streaming business could command similar or even greater investor enthusiasm given its deep library of content and rapidly growing subscriber base. The timing is also strategic. With a broader market hungry for tech-driven growth stories, streaming stocks have led the way this year, and cable networks have lagged. Splitting the business allows Warner Bros. Discovery to ride that streaming wave unencumbered and, in turn, grants the legacy networks freedom to optimize their advertising strategies and international distribution deals without being weighed down by streaming's capital-intensive expansion. Looking ahead, all eyes will be on the upcoming shareholder vote and regulatory approvals needed to finalize the separation. If Warner Bros. Discovery can pull off this transformation smoothly, it could trigger a repricing of the entire media sector and set a template for other conglomerates wrestling with divergent growth profiles. Either way, today's explosive move shows that in TV and film, as in the markets, split-second decisions can deliver blockbuster returns.